Legal disclaimer. The following content is intended exclusively for educational and entertainment purposes and does not constitute financial, investment, legal, or tax advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Past performance is not indicative of future results. All examples, charts, and case studies shown are for illustrative purposes only to demonstrate technical concepts and market dynamics. The creator of this content is not a registered financial advisor or broker-dealer. Viewers are strictly advised to conduct their own due diligence and consult with an independent, qualified financial advisor regarding their specific financial situation before engaging in any trading activities. By continuing to watch, you acknowledge that you are solely responsible for your own investment decisions and any resulting gains or losses. Here is the brutal reality that the financial industry tries to hide behind glossy brochures and smiling stock photos. The retail trader failure rate is widely estimated to hover between 90 and 95%. Let that statistic sink in for a moment. If you put 100 aspiring traders in a room, 95 of them will eventually blow up their accounts, losing every single dollar they deposited. In the industry, we call this the 90-90-90 rule. 90% of new traders lose 90% of their money within their first 90 days. This isn't an accident. It isn't bad luck. And it certainly isn't because the market is rigged, in the way conspiracy theorists believe. The market is a zero-sum environment in the short term. For you to sell at the top, someone else had to make the mistake of buying at the top. For you to make a profit, someone else somewhere in the world, whether it is a bank, a hedge fund, or another retail trader, has to take the other side of that transaction. The reason the vast majority fail is not because they lack capital or intelligence. It is because they are functionally illiterate when it comes to the language of the market. They are trying to read a book written in a foreign language without ever learning the alphabet. They look at a Forex chart, and they see red and green rectangles moving up and down. They see chaos. They see randomness. They see a video game. But the professional trader, the institutional analyst sitting at a desk in London or New York, looks at that exact same screen and sees something entirely different. They do not see chaos. They see a narrative. They see a rigorous, data-driven story of human psychology, fear, greed, and institutional order flow. They see a footprint. Every single movement on a chart, from the smallest tick on a 1-minute time frame to a massive monthly trend, is a footprint left behind by money. Massive amounts of money. We are talking about a market that moves over $6 trillion every single day. When that much capital moves, it leaves a trail. The problem is that most beginners are looking for a shortcut to bypass learning to track that trail. They load up their charts with squiggly lines, complex indicators, automated robots, and flashing signals that tell them when to buy or sell. They clutter their screen with so much debris that they can't even see the price anymore. They are trying to drive a car by looking at the speedometer and the tachometer, but they are refusing to look out the windshield at the road. This series is your windshield. Welcome to the Forex Charting Masterclass. This is not a quick 5-minute summary of basic patterns. We are not here to teach you a generic strategy that stops working the moment market conditions change. We are here to fundamentally rewire the way your brain processes financial data. Over the course of this 10-part deep dive, we are going to peel back the layers of the market structure. We are going to take you from absolute zero, looking at a blank grid, to a professional standard of technical analysis. You are going to learn that a chart is actually a distinct grammatical language. Just as a musician looks at sheet music and hears a symphony in their head, or a programmer looks at lines of code and sees a functional software architecture, you will learn to look at candlesticks and see the battle between buyers and sellers. You will understand why price stops exactly where it stops. You will understand why a market that looks like it is crashing is actually just rebalancing before a massive move upward. You will learn to identify where the smart money, the central banks and major financial institutions, have placed their orders, and more importantly, where they are waiting to trap the uneducated retail traders. If you are watching this, chances are you have felt the specific pain of analysis paralysis. You open your laptop, you pull up the euro to US dollar or the pound sterling to Japanese yen, and you freeze. You see the price going up on the 1-hour chart, but it's going down on the 4-hour chart. You see a buy signal from one indicator and a sell signal from another. You feel a tightness in your chest because you don't know which time frame is telling the truth. You make a trade based on a gut feeling, or perhaps a YouTube comment you read, and immediately the market moves against you. You watch your equity drop, the red numbers growing larger, and you pray for a reversal that never comes. Eventually, you close the trade in a panic, cementing the loss. 10 minutes later, the market moves exactly in the direction you originally thought it would. This experience is universal among beginners. It happens because you are trading patterns without understanding context. You are memorizing shapes without understanding the underlying mechanics of supply and demand. This tutorial series is designed to end that confusion permanently. We are going to deconstruct the chart into its rawest components. We will strip away the noise. We are going to explore the x-axis of time and the y-axis of price, and how the relationship between these two variables creates the market psychology. We will examine the anatomy of a Japanese candlestick, not just what it looks like, but what the wick and the body tell you about who won the battle during that specific time period. We will dive deep into the concept of fractals, understanding how market structures repeat themselves on different scales, and how to align the big picture with your entry trigger. This is a warning. This process requires patience. Real technical analysis is not about predicting the future with 100% certainty. That is a myth sold by charlatans. Real technical analysis is about probability management. It is about identifying scenarios where the odds are heavily stacked in your favor, and the potential reward significantly outweighs the risk. It is about acting like a sniper, waiting days for the perfect setup, rather than a machine gunner spraying bullets at everything that moves. By the end of this series, you will no longer need to rely on signal groups, guru alerts, or expensive magical software. You will be able to open a naked chart, just price and time, and read it like a newspaper. You will be able to identify the trend, spot the reversal, and pinpoint the exact price levels where the market is likely to react. You will move from being a victim of the market to being a student of the market. We are going to challenge everything you think you know about trading. We are going to dismantle the bad habits you may have picked up from short-form social media videos. We are building a foundation of stone, not sand. If you are ready to stop gambling and start analyzing, if you are ready to treat this with the professional respect it demands, then you are in the right place. We are about to turn on the lights in a dark room. Let's begin the education. To understand the Forex chart, you must first strip away every single indicator, every colored line, and every flashing light until you are left with the raw skeleton of the market. Imagine for a moment that you are an architect looking at a blueprint. Before you can worry about the interior design or the furniture, you must understand the foundation and the walls. In the financial markets, this foundation is built upon a two-dimensional grid. It seems deceptively simple, but this grid is where billions of dollars are won and lost every single hour. We are dealing with a standard Cartesian coordinate system, the same x and y axis you learned in grade school geometry, but with a specific financial application. The vertical axis, the y-axis, represents price. The horizontal axis, the x-axis, represents time. This sounds elementary, but do not let simplicity fool you. The relationship between these two axes is the entire story of the global economy playing out in real time. Let's drill down into the y-axis first, price. In the stock market, if you look at a chart of a tech giant like Apple, the y-axis is straightforward. It tells you the value of one share of Apple in US dollars. If the graph says 150, it means you need $150 to buy one share. But in Forex, the y-axis is fundamentally different. It is not a price, it is a ratio. This is where 90% of beginners get confused within the first 5 minutes. Because you are trading currencies, you are never just buying one thing in isolation. You are always exchanging one currency for another. Therefore, the number you see on the right-hand side of your screen, the y-axis, is an exchange rate. Let's use the most traded pair in the world, the euro to US dollar, as our primary case study. Imagine the current price on the y-axis reads 1.0950. What does that specific sequence of numbers actually represent? It means that one single euro, the base currency, is worth exactly $1.09 and half a penny of the quote currency, the US dollar. This is critical. The chart is tracking the strength of the first currency listed, the euro, relative to the second currency listed, the dollar. Imagine a teeter-totter or a seesaw on a playground. On the left seat sits the euro. On the right seat sits the dollar. The chart you are looking at tracks the movement of the left seat. If the line on the chart shoots violently upward, It does not necessarily mean the euro is becoming incredibly strong. Could mean the euro is staying exactly the same but the dollar is crashing. Or it could mean the euro is getting strong while the dollar is simultaneously getting weak. This is the concept of relative value. When you click buy on your trading terminal, you are technically buying the euro and simultaneously selling the US dollar. You are betting that the euro will gain value faster than the dollar, or that the dollar will lose value faster than the euro. Now, look closely at that price on the y-axis again. You will notice it usually goes out to 4 or 5 decimal places, for example 1.09505. Most beginners ignore the last digit, but professional high-frequency traders live and die by it. The 4th decimal place is what we call a pip, or percentage in point. For decades, this was the smallest increment of trade. However, modern technology and digital liquidity have introduced the 5th decimal place, known as a pipette or a point. Why does this matter? Because when you see the chart move from 1.09500 to 1.09510, that is a 1 pip move. In the world of Forex, unlike the stock market where you might look for a 10% gain, traders are hunting for these microscopic variances. A movement of 50 pips, which looks like a tiny blip on a monthly chart, can translate to thousands of dollars in profit or loss depending on your leverage. The y-axis is a ruler measuring the intensity of global capital flow. Every tick upward means buyers are aggressive. Every tick downward means sellers are liquidating. Now let's shift our focus to the x-axis, time. This is the variable that tricks the human brain the most. The x-axis is linear. It moves forward 1 second at a time, never stopping, never reversing. However, the way we view this data is through time frames. Imagine you are using Google Earth. You start by looking at the entire continent of North America. You can see the mountain ranges, the coastlines, and the massive weather systems. This is equivalent to the monthly or weekly chart in Forex. You can see the macro trend. You can see that over the last 5 years the trend has been moving upward. But at this altitude you cannot see the cars on the highway. You cannot see the traffic jams. Now imagine zooming in all the way to a street view in downtown Manhattan. You can see individual people, potholes, and taxi cabs. This is the 1 minute or 5 minute chart. It is chaotic, fast-paced, and noisy. Here is the paradox that traps beginners. Both charts are showing the exact same asset at the exact same price, yet they tell completely different stories. Let's run a scenario. Imagine you open your charting software and look at the 5-minute chart for pound sterling to US dollar, the British pound. You see a massive red line plummeting downwards. It looks like a crash. It looks like a financial disaster. Your instinct screams, sell. The market is collapsing. You enter a short position, expecting the price to fall further. However, if you had simply zoomed out to the daily time frame, the Google Earth continent view, you would have seen that this crash was just a tiny, insignificant pullback in a massive year-long upward trend. You just sold at the exact moment professional banks were buying the dip. 10 minutes later, the price rips upward, wiping out your account. This is why understanding the x-axis is a survival skill. You are not just trading price, you are trading price over time. You must understand the concept of fractals. A fractal is a pattern that repeats itself on different scales. Market trends are fractal. A downtrend on a 15-minute chart can exist inside an uptrend on a 4-hour chart, which can exist inside a downtrend on a weekly chart. When we talk about reading the chart, we are really talking about aligning these time frames. We are looking for the moment when the tide, the monthly chart, the waves, the daily chart, and the ripples, the 1-hour chart, are all moving in the same direction. When you achieve that alignment, you are no longer swimming upstream. You are surfing with the full force of the ocean behind you. Consider the data density of the x-axis. If you are looking at a 1-hour chart, every single data point on that horizontal axis represents 60 minutes of bidding, asking, fighting, and negotiating between millions of participants. That single hour might contain the news release of a US inflation report, a speech by the Federal Reserve Chairman, and a massive corporate hedge fund rebalancing their portfolio. All of that complexity is compressed into one slice of the x-axis. The novice looks at the chart and asks, where is the price going? The professional looks at the axis and asks, where has the price been, how long did it take to get there, and is the current speed sustainable? We have established the grid. We have the vertical measurement of value and the horizontal measurement of time. But currently, if we were to just plot the price as a simple line connecting the closing prices, we would be functionally blind. A simple line chart, which is what you see on basic apps like Robinhood or Google Finance, is woefully inadequate for professional analysis. Why? Because a line chart only gives you one piece of data: the closing price. It tells you where the price ended up at the end of the hour, but it completely hides what happened during that hour. Did the price crash and recover? Did it skyrocket and then get pushed back down? Was it a quiet hour or a volatile one? A line chart hides the drama. It hides the emotional footprint of the market participants. To truly read the market, we need a tool that displays 4 dimensions of data simultaneously: the open, the high, the low, and the close. We need a visual tool that originated in 18th century Japan, developed by a legendary rice trader named Munehisa Homa, to track the psychology of rice merchants. This tool is the Japanese candlestick. Without understanding the anatomy of a candlestick, looking at a Forex chart is like trying to read a novel where every second page has been torn out. You are missing the context, the conflict, and the resolution. In the next section, we are going to dissect the Japanese candlestick. We will reveal how a simple rectangular bar and a thin line can tell you exactly when buyers are exhausted and when sellers are about to take control. You will learn to spot the specific shapes that precede massive market reversals. The lights are on, but now we need to learn to see the details. If you can look at a single Japanese candlestick and read the story it is telling you, you are already ahead of 80% of the retail traders trying to navigate these waters. Most people see a green rectangle and think buy, or a red rectangle and think sell. That is the depth of their analysis, and that is why they lose. To the professional, a candlestick is not a static shape. It is a crime scene. It is a frozen record of a violent struggle between buyers, the bulls, and sellers, the bears, over a specific period of time. Let's dissect this crime scene. A candlestick is composed of 2 primary distinct parts: the body and the wicks, sometimes called shadows. The body is the thick, colored part in the middle. This represents the conviction of the market. It measures the distance between the open price and the close price. The open is the exact price level where the market stood the nanosecond that specific time period began. The close is the exact price level where the market stood the nanosecond that period ended. If the close is higher than the open, the body is typically colored green or white. This is a bullish candle. It tells you that by the end of the round, the buyers had pushed the price up and held the ground. They won the round. If the close is lower than the open, the body is typically colored red or black. This is a bearish candle. It tells you that sellers swarmed the market and suppressed the price, forcing it to finish lower than where it started. They won the round. But the body is only half the story. Often, the most critical information, the data that hints at future reversals, is hidden in the wicks. The wicks are the thin lines extending above and below the body. They represent the high and the low of that specific session. But don't just memorize those terms. Think about what they actually mean. The top of the upper wick represents the maximum price buyers were able to achieve before they were overpowered. The bottom of the lower wick represents the lowest price sellers were able to achieve before they were pushed back. Think of the wick as a failed invasion. If you see a long wick sticking out the top of a candle, it means buyers tried to invade higher prices. They pushed up, they fought hard, they momentarily breached new levels, but they could not hold the territory. Sellers stepped in with massive limit orders and drove them back down. That upper wick is a scar. It is visual proof of rejection. Let's run a real-time simulation to solidify this. I want you to visualize the formation of a single 1-hour candle on the euro to US dollar chart. Imagine it is exactly 9 a.m. in New York. The liquidity is high. The previous candle closes and a new candle forms. The price opens at 1.1000. This is our open. For the first 15 minutes, the market is quiet. But then negative news hits the wire. Sellers panic. They start hitting the sell button aggressively. The price drops. It smashes through 1.0990, then 1.0980, all the way down to a low of 1.0950 by 9:30 a.m. On your screen, you would currently see a long solid red bar. It looks like a total collapse. The novice trader is looking at this live and thinking, the trend is down. I need to sell now before it drops further. But the hour is not over. At 9:45 a.m., institutional algorithms kick in. They see 1.0950 not as a crash but as a discount. Massive buy orders hit the market. The price stops falling instantly, starts to grind back up. It climbs back to 1.0980, erasing half the losses. The buyers are gaining confidence. By 9:55 a.m., the price is back to 1.1000, the opening price. The red body has completely disappeared. Now, in the final 5 minutes, the buying frenzy intensifies. The price shoots up to 1.1020. Finally, the clock strikes 10 a.m. The candle closes. What do you see on the chart now? The history of that drop to 1.0950 is gone from the body. The body is now green, sitting between 1.1000 open and 1.1020 close. But hanging below that body is a massive long lower wick. That long lower wick tells the educated trader a fascinating story. It says, the sellers had control. They tried to push the price down to 1.0950, but they failed. The buyers were so strong that they not only absorbed all the selling pressure, but pushed the price to a new high. This specific shape, a small body with a long lower wick, is what we call a hammer or a pin bar. It is a classic reversal signal. It screams that the market sentiment has shifted from bearish to bullish within that hour. If you were only looking at a line chart, you would miss this entire drama. You would see a simple dip and rise. But the candlestick reveals the intensity of the rejection. Conversely, consider the Maribozu. Imagine a candle that opens and immediately shoots up. It goes up and up and up, never looking back. It closes at the very highest point of the hour. This candle has no wicks. It is just a solid fat block of green color. What does this tell you? It tells you there was zero hesitation. There was no rejection. Sellers couldn't even push the price down by a single pip. This indicates extreme momentum. It suggests that the smart money is aggressively entering the market and is likely to continue pushing the price higher in the next candle. You must learn to gauge the range of the candle. The range is the total distance from the high to the low. A tiny, compressed candle with a small body and small wicks indicates indecision. The market is taking a breath. Neither buyers nor sellers are willing to commit. This is often the calm before the storm. A massive, elongated candle indicates high volatility and heavy volume. It means a major decision has been made. When you see a series of small candles followed by one massive expansion candle, that is often the breakout signal traders wait days for. Understanding OHLC, open, high, low, close, is the literacy test of trading. You need to train your eyes to scan a chart and instantly interpret the last 5 candles as a narrative sentence. Buyers tried to push up upper wick, failed, close high. Sellers took over red body, momentum is increasing, large body. That is a sentence. That is a bearish signal. Sellers pushed down lower wick, failed, close low. Buyers stepped in green body, but the range is tiny, small body. That is a sentence. That is a signal of weak bullishness or consolidation. You are no longer looking at lines. You are looking at the footprints of millions of traders. You are seeing where the panic happened, the wicks, and where the consensus was reached, the body. However, knowing the anatomy of a single candle is like knowing the definition of a single word. It is useful, but it doesn't let you write a novel. To truly read the market, you need to understand how these words string together to form sentences, paragraphs, and chapters. You need to understand how one candle interacts with the candle next to it. What happens when a massive green candle is immediately followed by an even bigger red candle that completely engulfs it? What does it mean when 3 candles in a row have long upper wicks, all stopping at the exact same price level? These are candlestick patterns. These are the recurring setups that have appeared in the markets for over 300 years, from the rice warehouses of Osaka to the high-frequency servers of Wall Street. They are the specific visual triggers that tell you the probability of a move is now in your favor. In the next part of this masterclass, we are going to catalog the most powerful candlestick patterns in existence. We are going to teach you to spot the engulfing bar, the doji, and the morning star. But we aren't just going to show you pictures. We are going to show you exactly where they need to appear on the chart to be valid. Because a pattern in the wrong location is a trap. A pattern in the right location is a profit opportunity. The vocabulary lesson is over. It is time to learn the grammar of money. We are now entering the grammar phase of our education. If a single candlestick is a word, then a candlestick pattern is a complete sentence. It is a specific arrangement of price data that conveys a clear message about the future intent of the market. However, before we hand you the keys to these powerful setups, we must burn a golden rule into your mind. A pattern is only as good as its location. Think of a stop sign. If you see a red octagonal stop sign at a busy 4-way intersection, it is a critical, life-saving signal. You obey it. But if you see that exact same red stop sign lying face down in a ditch in the middle of a cornfield, it means absolutely nothing. It is just trash. Most beginners trade trash patterns. They see a specific shape in the middle of a chart, surrounded by noise, and they bet their savings on it. Today we are going to teach you to identify the sign, but in the next videos we will teach you how to identify the intersection. You need both to survive. Let's begin with the most famous signal of indecision, the doji. Shutterstock. Explore. Visually, the doji is unmistakable. It looks like a cross or a plus sign. It happens when the market opens at a specific price, travels up and down violently during the session, but then closes at the exact same price it opened at. The body is virtually non-existent. It is just a thin horizontal line. Psychologically, this represents a perfect stalemate. Imagine a tug-of-war between a team of professional football players, the Bulls, and a team of professional rugby players, the Bears. They pull back and forth for an hour, sweating, grunting, digging their heels into the mud. But when the whistle blows, the flag in the middle has not moved a single inch from the center. That is a doji. Why is this valuable? Because it represents a pause in momentum. If you see a doji appear after a massive long uptrend, it is a warning shot. It tells you that the buyers, who have been in control for days, are suddenly exhausted. They ran out of ammo. They could not push the price higher than the open. This equilibrium often precedes a reversal. It is the market taking a deep breath before plunging in the opposite direction. However, a doji in a sideways, quiet market is meaningless. Just means nobody is trading. Context is everything. Now let's move from indecision to aggression. Let's talk about the engulfing pattern. Shutterstock. Explore. If the doji is a whisper, the engulfing pattern is a scream. This is a two-candle formation that signifies a massive shift in power. Let's visualize a bullish engulfing setup. First, you have a red candle. Sellers are in control. The price drops. Immediately following that red candle, a green candle forms. This green candle opens lower than the previous close, but then surges upward with immense volume. It closes higher than the previous candle's open. Visually, the green body completely overlaps and swallows the previous red body. This tells a violent story of order flow. It means that every single seller who entered the market during the first candle is now underwater. They are trapped in a losing position. Panic sets in. As the price rises, those short sellers are forced to buy back their positions to cover their losses, which fuels the rally even further. Simultaneously, breakout traders see the momentum and jump in long. It is a self-fulfilling prophecy of buying pressure. Conversely, a bearish engulfing is the exact opposite. A small green candle is followed by a massive red candle that completely consumes it. This is often seen at the very top of a trend, marking the exact moment the smart money decided to dump their holdings on the retail public. Historical data suggests that engulfing patterns found at the end of prolonged trends have a higher statistical probability of resulting in a reversal than those found in the middle of a chop. You are looking for a shock to the system, a sudden change of character in the price action. Next, we have the morning star and the evening star. These are three-candle formations, and they are arguably the most reliable reversal patterns in the Forex market because they unfold over a longer period, giving them more weight. Shutterstock. Explore. Let's dissect the morning star. It is a bullish reversal pattern that usually appears at the bottom of a downtrend. Plays out in 3 acts like a movie. Act 1, the crash. A long aggressive red candle. The bears are celebrating. The price is plummeting. Confidence in the downtrend is high. Act 2, the hesitation. A small candle forms. It can be a doji or a spinning top. A small body with equal wicks. The key here is the gap. The price often gaps down, but then it goes nowhere. The momentum dies. The sellers look around and realize there is nobody left to sell to. Act 3, the reversal. A strong green candle bursts onto the scene. It closes deep into the body of the first red candle. This sequence is powerful because it captures the entire emotional cycle of a market bottom. Panic, indecision, and finally recovery. When you see a morning star, you are seeing the visual representation of hope returning to a market. The evening star is the bearish equivalent, found at the top of an uptrend. A strong rally, a moment of hesitation at the peak, and then a sharp collapse. But here is the trap. Here is where the 90-90-90 rule claims another victim. You will open your chart and you will see these patterns everywhere. You will see a bearish engulfing pattern and think, aha, the script said this means the market will drop. You sell. and the market rips against you, taking your money. You see a morning star and you buy. The market crashes further. Why? Because you are ignoring the landscape. You are trying to read the sentence without reading the paragraph. Imagine you are a general on a battlefield. You see a signal flare go up, the candlestick pattern. That flare means attack. But if you attack while your army is standing in a swamp, surrounded by enemies on high ground, you will be slaughtered regardless of the signal. You must filter these patterns through the lens of market structure. A bullish engulfing pattern is only a buy signal if it happens at a structural floor. A bearish engulfing pattern is only a sell signal if it happens at a structural ceiling. We call these floors and ceilings support and resistance. These are invisible horizontal lines where the price has historically reversed. They are the memory of the market. If a bullish engulfing pattern forms exactly on a support level that has held for 3 years, that is a great setup. That is when you strike. If it forms in the middle of a range, it is noise. The charts are a map of human psychology, but support and resistance are the coordinates where that psychology is tested. Without them, you are lost at sea. So, how do you find these invisible lines? How do you know which price levels the banks are defending with billions of dollars? How do you draw a line on your chart that predicts where the price will stop 3 weeks from now? Most people draw them wrong. They draw random lines connecting random wicks and wonder why they don't work. In the next part of this deep dive, we are going to teach you the precise art of drawing support and resistance zones. We are going to show you how to look back in time to predict the future. We are going to turn your chart from a blank canvas into a strategic battle map. Get your drawing tools ready. The grid is about to get populated. Imagine walking into a pitch-black room. You walk forward cautiously until your hand hits a wall. You turn right, take 5 steps, and hit another wall. Eventually, even without sight, you build a mental map of the room's boundaries. You know exactly where you can walk freely and exactly where you will be stopped. The Forex market is that room. It has walls, a floor, and a ceiling. But unlike a physical room, these boundaries are constructed entirely out of money, memory, and human psychology. We call these boundaries support and resistance. This concept is the heartbeat of technical analysis. If you strip away every other complex theory, trading simply comes down to buying at support and selling at resistance. But most people treat these terms as vague suggestions. To the professional, they are concrete zones of institutional defense. Support is the floor. It is a price level where demand buying power is perceived to be strong enough to prevent the price from falling further. Think of it as a zone where a swarm of buyers is waiting with open limit orders. When the price drops into this zone, it becomes cheap relative to recent history. The buyers step in, the sellers dry up, and the price bounces. Resistance is the ceiling. It is a price level where selling pressure is strong enough to prevent the price from rising higher. It is a zone where the market feels expensive. Buyers become hesitant to pay more, and sellers, seeing a good profit, start unloading their positions. The price hits this invisible roof and is rejected. But here is the secret that separates the amateur from the pro. These are not just lines on a chart. They are scars. Every major support or resistance level exists because of a traumatic financial event in the past. Go back to a chart of the US dollar to Japanese yen. Find a peak where the price shot up and then crashed violently. At that exact peak, thousands of retail traders bought the top. They bought right before the crash due to FOMO, fear of missing out. Now, imagine the psychology of those traders. For weeks or months, they have been holding a massive losing position, praying for the price to come back up so they can get out at break-even. If the price ever returns to that level, what will those traumatized traders do? They will sell. They will sell just to end the pain of the loss. That wave of desperate selling creates resistance. The market remembers. So, how do we draw these zones correctly? First, delete every line on your chart. We are starting fresh. Switch your time frame to the weekly or daily chart. Remember the Google Earth view? Higher time frames carry significantly more weight. A support level on a 5-minute chart is like a paper wall. You can punch through it with a finger. A support level on a weekly chart is like a concrete bunker. Look for the sharp V shapes. We are not looking for gentle, rounded curves. We are looking for areas where the price touched and was violently rejected. If the price hit a level and immediately flew 200 pips in the opposite direction, mark that level. That is a key level. Now here is the golden rule of drawing. Support and resistance are zones, not lines. This is where 90% of beginners fail. They draw a single thin horizontal line at exactly 1.0500. Then the price drops to 1.0495. just 5 pips lower before bouncing. The beginner screams, "The support broke. It's a breakout." They sell, and the market instantly reverses and destroys them. Why? Because they treated a dynamic, organic market like a precise geometry problem. You must use the rectangle tool on your trading platform. Draw a zone that encompasses the wicks of the candles. You are trying to catch a region of interest, usually between 10 to 30 pips wide depending on the pair's volatility. Price is messy. Give it room to breathe. Let's analyze the phenomenon of role reversal. This is arguably the single most profitable concept regarding horizontal levels. Imagine a multi-story building. You are standing on the floor of the second story. That floor is your support. If you jump up and down, it holds you. But if you get a sledgehammer and smash through that floor, you fall down to the first story. Now look up. That same surface that used to be your floor is now your ceiling. It used to be support. Now it is resistance. The market works the exact same way. When a major support level is finally broken, when the sellers are so aggressive they smash through the floor, that level flips. If the price later rallies back up to that level, it will often find resistance there. This creates one of the most reliable setups in technical analysis: the break and retest. Scenario: you see the euro to US dollar range bound between 1.1000 and 1.1200. It has bounced off 1.1000 3 times. Finally, a massive red candle smashes through 1.1000 and closes at 1.0950. The amateur sees the breakdown and chases the price, selling at 1.0950. This is risky. The price is already extended. The professional waits. They wait for the price to breathe. They wait for the price to climb back up to 1.1000. They want to see if the old floor will act as a new ceiling. If the price touches 1.1000 and prints a bearish engulfing pattern or a long upper wick, that is the confirmation. That is the entry. You are selling at a premium price, with a logical stop loss just above the ceiling. Let's deepen this with the concept of psychological round numbers. Human beings are simple creatures. We like round numbers. If you are selling your car, you don't list it for $19,843. You list it for $20,000. Banks and hedge funds are run by humans, or algorithms programmed by humans. Therefore, massive clusters of orders tend to sit at big figures. In Forex, these are prices ending in 0050 or 000. For example, 1.3000 is a significantly stronger psychological barrier than 1.3017. If you are drawing a support zone and you see it lines up perfectly with a double zero number like 150.00 on the yen pairs, that level instantly becomes twice as significant. Historical analysis shows that price will often overshoot these levels slightly to trigger stop losses, a move called a stop hunt, before reversing. This is why your zones must have width. If you place your stop loss exactly on the line, the market will fetch it like a dog fetching a ball. Look at your chart right now. Identify the last 3 major turning points. Draw your rectangles. Extend them to the right into the blank space of the future. You have just built a predictive model. You are no longer guessing where the price might react. You have marked the battlefields in advance. You are waiting for the enemy to walk into your ambush. However, the market does not always move in straight horizontal lines. In fact, the most explosive moves in Forex are rarely horizontal. They are diagonal. The market climbs stairs, it slides down ramps. It moves in trends. Horizontal levels are great for ranging markets, but if you try to use them in a trending market, you will get run over by the train. You need a way to track the angle of the attack. You need to know how to measure the speed of the trend, and more importantly, you need to know exactly when that trend is broken. There is a specific tool for this, perhaps the most subjective yet powerful line you can draw. It connects the lows of an uptrend and the highs of a downtrend. But if you draw it wrong, it will lie to you. It will tell you the trend is intact when it is actually collapsing. In the next part of this masterclass, we are going to master trend lines and channels. We will show you the 3-touch rule that filters out false signals. We are going to teach you how to surf the wave instead of standing in front of it. The grid is populated, but now we need to add motion. Let's get moving. If horizontal support and resistance are the concrete floors of a building, trend lines are the escalators. They carry the price from one level to the next, and understanding their mechanics is the difference between catching a ride to the penthouse and falling into the basement machinery. The market rarely moves in a straight line like a laser beam. It moves in a rhythm a breathing pattern of expansion and contraction. When you connect these rhythmic beats with a diagonal line, you are not just drawing a line. You are measuring the velocity of human greed and fear. Most beginners draw trend lines incorrectly. They open a chart, see a vague diagonal movement, and slap a line across the middle of the price action, cutting through candle bodies like a knife through a cake. This is useless. It creates a best fit line that tells you nothing about where the market will actually react. To draw a professional trend line, you must act like a structural engineer. You are looking for the load-bearing points. Let's break down the anatomy of an uptrend. An uptrend is defined strictly by a series of higher highs and higher lows. The market pushes up, takes a break, pulls back, and then pushes higher than before. To draw the trend line, you must connect the higher lows. You are drawing the line underneath the price. You are building a ramp. You do not care about the highs yet. You only care about the floor that is rising beneath the price. Conversely, in a downtrend defined by lower highs and lower lows, you connect the lower highs. You are drawing the line above the price. You are tracking the ceiling that is pushing the price down into the dirt. Now we arrive at the most critical concept in diagonal analysis: the three-touch rule. This rule is the filter that separates signal from noise. Touch 1. This is just a random point in space. It is the start of a move. It means nothing on its own. Touch 2. This establishes a tentative angle. If you connect point A to point B, you have a line. But in geometry, any 2 points can be connected. This does not mean the market respects this line. It is just a hypothesis. Touch 3. This is the validation. This is the money shot. When the price pulls back to your line for the third time and bounces, the market has confirmed the structure. The algorithmic traders, the bank desks, and the hedge funds have all silently agreed. This specific angle is the trend. Once you have that third touch, the trend line is active. Imagine a scenario on the pound sterling to Japanese yen, British pound versus Japanese yen, a pair known for its volatility. You spot a low at 150.00. Days later, it hits 152.00 and pulls back to 151.00. You draw a line connecting the 150.00 low and the 151.00 low. You extend that line out into the future. 2 weeks later, the price is trading at 155.00 and starts to crash. It drops fast. Panic sets in. But you are watching your line. The line is now sitting at exactly 153.50. The price slams into 153.50. The amateur sees a falling knife. You see a trampoline. If the price touches that line and prints a bullish candlestick pattern, like the hammer we discussed in Part 3, historical trends suggest a high probability of a bounce. You are buying at the exact point where the trend integrity is being defended. However, you must also analyze the slope of the trend line. Physics applies to markets. If a trend line is too steep, say 70 or 80 degrees, it is unsustainable. It is a parabolic move. It represents panic buying, FOMO. Like a sprinter running at full speed, the market will gasp for air. These trend lines break easily and often result in violent corrections. If a trend line is too flat, say 10 or 15 degrees, the momentum is weak. The market is barely crawling. This trend is susceptible to being broken by random noise. The Goldilocks trend line is usually around 45 degrees. This represents a healthy, sustainable accumulation of orders that can last for months or even years. Now, let's upgrade your toolkit from a single line to a channel. Markets often seek symmetry. If there is a clear floor, trendline support, there is often a parallel ceiling. In your charting software, most tools allow you to clone a line. If you are in an uptrend, draw your support line across the lows. Then clone that line and drag the copy up to the highs. Often you will see something spooky. The price fits perfectly inside these two parallel tracks. This is an ascending channel. The channel provides you with a complete battle plan. You buy at the bottom of the channel, support, and you take profits at the top of the channel, resistance. Think of the price as a ping-pong ball bouncing between two walls in a hallway. As long as the ball stays in the hallway, you play the bounce. But eventually the ball will break the wall. This brings us to the trendline break. Nothing lasts forever. Every trend, no matter how strong, will eventually break. But how you handle the break determines your survival. The amateur sees the price cross the trendline by 1 pip and screams, "Reversal." They sell everything. Then the candle closes back inside the trendline, leaving a long wick. The amateur was faked out. This is why we wait for a candle close. A trend line is not broken until a candle on your time frame, e.g. the daily or 4-hour, physically closes beyond the line. Even then, we do not rush. We follow the break and retest principle we learned with horizontal levels. Imagine an uptrend line that has held for 6 months. Suddenly, a massive red candle smashes through it. The trend is broken. Do you sell immediately? No. That is chasing the trade. Usually, the price will rally back up to kiss the underside of the broken trend line. It wants to say goodbye. It tests the old support to see if it is now resistance. If it touches the underside and gets rejected, that is your entry. That is the lower high that confirms the new downtrend has begun. Let's illustrate this with a fan principle case study. Imagine a trend line breaks. You draw a new flatter trend line connecting the new low. That one breaks too. You draw a third, even flatter one. When the trend curve begins to flatten out like a fan opening up, it indicates the buyers are slowly losing their grip. The aggressive slope becomes a moderate slope, which becomes a flat slope. Eventually, the floor gives way entirely. You also need to understand time frame confluence with trend lines. If you are drawing a trend line on a 15-minute chart, and it intersects with a massive trend line from the weekly chart, the weekly line is concrete, the 15-minute line is plywood. When they collide, the weekly line will win. Always zoom out to check if your small trend is running headfirst into a massive wall you couldn't see. We have now constructed a robust cage for the price. We have horizontal floors and ceilings, support/resistance. We have diagonal ramps and slides, trend lines/channels. We can see the structure. We can see where the price is allowed to go and where it is forbidden. But there is a missing piece of the puzzle. We can see the car moving. We can see the road it is driving on. But we cannot see the dashboard. We don't know if the engine is overheating. We don't know if the gas tank is empty. We don't know if the driver is slamming on the brakes even though the car is still moving forward. Momentum is the hidden force that precedes price. Often, momentum will shift before the price turns. The car will slow down before it makes a U-turn. If you are only looking at the candles, you might miss the deceleration until it is too late. To see inside the engine, we need to introduce a new class of tools. We need oscillators. Specifically, we are going to look at the RSI, Relative Strength Index. This is not just a squiggly line at the bottom of your screen. It is a lie detector test for the market trends. It tells you when a trend is lying about its strength and is secretly preparing to crash. In the next part, we are going to teach you how to spot divergence, the single most powerful signal an oscillator can give. It is the cheat code that lets you spot a top before the top actually forms. You have the map. Now you need the speedometer. Imagine you are driving a sports car up a steep mountain road. The car represents the market price. The road represents the trend. As you climb higher and higher, your speedometer shows you are still moving forward at 60 miles per hour. But if you looked closely at the RPM gauge, the revolutions per minute of your engine, you might notice something terrifying. Even though the car is still moving forward, the engine power is dropping. You are flooring the gas pedal, but the engine is sputtering. The momentum is dying. If you were only looking out the windshield, price action, everything would look fine. You are still moving up. But because you check the dashboard, momentum, you know that the car is about to stall and roll backwards down the cliff. You know a crash is imminent before the car actually stops moving. This is exactly what an oscillator does for a trader. It is your engine gauge. It measures the internal strength of the market movement. And the specific gauge we are going to master today is the Relative Strength Index, or RSI. Shutterstock. Most beginners use the RSI completely wrong. They treat it like a simple on-off switch, which is why they lose money. To use it like a professional, we first need to understand what it is actually measuring. The RSI is a line graph that moves between 0 and 100. It calculates the ratio of upward moves to downward moves over a set period, usually the last 14 candles. When the line goes up, buyers are winning. When the line goes down, sellers are winning. Here is the trap that catches 90% of new traders. The concepts of overbought and oversold. Open any basic trading textbook and it will tell you this. If the RSI line crosses above 70, the market is overbought. You should sell. If the RSI line crosses below 30, the market is oversold. You should buy. If you follow this advice blindly, you will destroy your trading account in less than a month. Let me explain why with a brutal reality check. Imagine a massive financial crisis hits. The pound sterling to US dollar crashes. Panic selling floods the market. The price drops vertically. The RSI slams down below 30. It hits 20. It hits 15. According to the textbook, this is oversold, and you should buy. So you buy. But the panic isn't over. The price keeps crashing. It drops another 500 pips. The RSI stays flat at the bottom, hugging the 15 level for weeks. The market can stay oversold far longer than you can stay solvent. In a strong trend, the RSI hitting 70 or 30 is not a reversal signal. It is actually a strength signal. It tells you the trend is so powerful that it is breaking the boundaries. Selling a strong uptrend just because the RSI is at 75 is like standing in front of a freight train just because it is running fast. So, if we don't use the 70/30ths rule for entries, what do we use the RSI for? We use it to spot the lie. We use it to find divergence. Divergence is the single most powerful signal in technical analysis because it reveals a disagreement between the price, the result, and the momentum, the cause. There are two types of regular divergence you must memorize. 1. Regular bearish divergence, the reversal top. Imagine the price of Bitcoin is rallying. It hits a high of $60,000. The RSI hits a high of 80. The market pulls back, then rallies again. The price breaks the previous record and hits a higher high of $65,000. The bulls are cheering. The news is ecstatic. But look at the RSI. Even though the price made a higher high, the RSI makes a lower high. It peaks at 65 instead of 80. What does this mean? It means the second rally was weaker than the first. It means the buyers had to use less energy to push the price higher, or that fewer participants were involved. The price is lying. It is a fake-out high. This disagreement is bearish divergence. It is the engine sputtering on the mountain. Often, immediately after this signal appears, the trend collapses. 2. Regular bullish divergence, the reversal bottom. Now flip the scenario. The euro to US dollar is in a downtrend. It drops to 1.0500. The RSI drops to 25. The price bounces slightly, then crashes again to a lower low of 1.0400. It looks like a bottomless pit, but the RSI does not make a lower low. Instead, it makes a higher low. It stops at 35. This tells you that the sellers are exhausted. Even though they push the price deeper, the selling pressure, the momentum has decreased. They are running out of steam. The rubber band is stretched too far and is about to snap back. This is your signal to start looking for buy opportunities, specifically if you are at a support level. Let's walk through a step-by-step case study to see how you combine this with what we learned in previous videos. The setup. You are looking at the 4-hour chart of gold, XAU/USD. Step 1. Structure. You identify a major resistance zone at $2,000. The price has rejected this level twice in the past. Step 2. Pattern. The price rallies aggressively up to $2,000. It hits the zone. You look at the candles. You see a shooting star or a long upper wick. This is the visual sign of rejection. Step 3. The lie detector. You look down at your RSI. On the previous peak, when price was at $1,980, the RSI was at 75. Now with price at $2,000, a higher high, the RSI is at 55, a massive lower high. The analysis. You have confluence. You have a key level resistance, a price action trigger, candlestick wick, and momentum confirmation, bearish divergence. This is a grade A trade setup. You are not guessing. You are identifying a specific structural weakness in the market. You place your sell order. You place your stop loss just above the resistance zone. You are betting on the exhaustion of the buyers. But there is another layer to this. We call it hidden divergence. Regular divergence predicts reversals. Hidden divergence predicts trend continuation. It is the buy the dip signal professionals use. Imagine an uptrend. The market is making higher highs and higher lows. The price pulls back to a support trend line. The price makes a higher low compared to the previous swing low, maintaining the uptrend structure. However, the RSI drops significantly lower than it did on the previous pullback. It makes a lower low. This sounds confusing, but think about the logic. The price held up well, higher low. Even though the selling momentum was intense, lower low on RSI. This shows hidden strength. It shows that the buyers absorbed a massive wave of selling without letting the structure break. This is a slingshot. Usually, the price will rocket upwards out of this setup, continuing the trend. Warning: do not hunt for divergence in a flat, sideways market. If the market is ranging between two tight levels, the RSI will give you false signals all day long. Divergence is a tool for trend extremes. It is designed to catch the tops and the bottoms of significant moves. Also, never execute a trade solely because of the RSI. Divergence is a condition, not a trigger. Divergence says, the market is ready to turn. It does not say the market is turning right now. You still need to wait for the candle to close, or for a trend line to break to confirm the timing. Divergence loads the gun. Price action pulls the trigger. So let's review our dashboard. We have the map, market structure / support and resistance. We have the road signs, candlestick patterns. We have the path, trend lines. And now we have the engine gauge, RSI divergence. We are building a complete trading system. But there is one major problem we haven't solved yet. The market is noisy. Prices spike up and down randomly due to news and algorithms. Sometimes looking at the raw candles is too chaotic. It's like trying to track the average height of waves in a storm while being tossed around on a boat. We need a way to smooth out the data. We need a tool that filters out the random noise and shows us the true path of the trend over time. We need a tool that acts as a dynamic support level that moves with the price. In the next part of this deep dive, we are going to introduce the moving average. But we aren't just going to use the default settings. We are going to show you the golden cross and the specific institutional settings that banks use to define the trend. If the RSI is the speedometer, the moving average is the GPS. Tells you exactly which lane you should be in. Let's smooth out the chaos. Imagine trying to walk in a perfectly straight line on the deck of a ship during a violent storm. You stumble left, you stumble right, you correct your balance, and you stumble again. If someone were to track your individual footsteps, the path would look chaotic, jagged, and nonsensical. However, if they were to look at your path from a drone flying overhead, they would see that despite the staggering, you are generally moving in a straight line toward the bow of the ship. In the financial markets, the price action, the individual candlesticks we have been studying, is your staggering footsteps. It is full of noise, panic, and erratic twitching. The moving average is the drone view. It is the smooth, calculated path that reveals the true destination despite the chaos of the moment. A moving average MA is a technical indicator that smooths out price data by creating a constantly updated average price. It takes the closing prices of the last X number of candles, adds them up, divides by X, and plots a point. Connect those points and you have a line that cuts through the noise. But not all moving averages are created equal. There are two main types you need to know: the simple moving average, SMA, and the exponential moving average, EMA. The simple moving average is the democratic version. It treats the price from 200 days ago with the exact same importance as the price from yesterday. It is slow. It is like turning a massive cruise ship. It takes a long time to change direction. The exponential moving average is the aristocratic version. It believes that now is more important than then. It applies a mathematical weighting to the most recent data. It reacts faster to sudden price spikes. For the fast-paced world of Forex trading, where we are capturing intraday volatility, the EMA is generally the weapon of choice. It gets you into the trend sooner and gets you out before the crash accelerates. Now let's talk about settings. If you open your trading platform, the default setting is usually 14 or 9. Delete those. We are not here to trade like a retail bot. We are here to align with the institutions. The banks, the hedge funds, and the mutual funds watch specific psychological averages. If you want to surf their waves, you need to use their surfboards. The three most critical numbers are the 20, the 50, and the 200. The 200 EMA is the godfather of indicators. It is the dividing line between a macro bull market and a macro bear market. Go to a daily chart. If the price is trading above the 200 EMA, the long-term trend is up. You should only be looking for buy setups. If the price is below the 200 EMA, the trend is down. You should only be looking to sell. It is your ultimate bias filter. If you try to buy when the price is below the 200 EMA, you are trying to swim up a waterfall. Historical trends show that price often respects this line with eerie precision. It acts as a massive concrete floor or ceiling. The 50 EMA is the swing trend. It tracks the medium-term momentum. This is often the line that holds the trend during a healthy pullback. The 20 EMA is the momentum. In a strong, aggressive runaway trend, the price will hug the 20 EMA like a magnet. This brings us to the concept of dynamic support and resistance. We previously learned about static horizontal lines. Those are fixed prices. But the market is fluid. Often the price will pull back, but it won't quite reach your horizontal support level before taking off again. Why? Because it bounced off the moving average. Imagine the euro to US dollar is rallying. It shoots up, then starts to drift down. It hasn't hit a horizontal support level, but it touches the 50 EMA. Suddenly buyers step in. Why? Because algorithms are programmed to buy the dip at the average price. The moving average acts as a rising floor. If you see a candlestick pattern like a hammer or an engulfing bar form exactly as the price touches the 50 EMA, that is a high probability entry signal. You have the trend, slope of the EMA, the value, pullback to the EMA, and the trigger, candlestick. Now let's address the most famous strategy involving these lines: the golden cross and the death cross. These terms sound dramatic because they represent major shifts in global capital flow. A golden cross happens when a faster moving average, usually the 50, crosses above a slower moving average, usually the 200. This signifies that short-term momentum is now overpowering the long-term average. It is a signal that a new bull market has likely begun. When the financial news headlines scream, "Stock market enters bull phase," they are usually reacting to a golden cross. A death cross is the opposite. The 50 crosses below the 200. The short-term sentiment has soured and dragged the average down. This signals a potential long-term bear market. However, there is a massive warning label attached to this strategy. Moving averages are lagging indicators. They are based on past data. By the time the 50 actually crosses the 200, the market might have already moved thousands of pips. If you buy the exact moment of the cross in a sideways chopping market, you will get destroyed. The cross is not a trigger to click buy immediately. It is a signal to change your bias. Tells you which direction to hunt, not when to shoot. This leads to the concept of mean reversion, or the rubber band effect. Think of the moving average as home base. The price is a dog on a rubber leash attached to home base. The dog can run away, trend, but the further it gets from home, the tighter the leash gets. Eventually, the tension becomes too great, and the dog is snapped back toward the owner. If you look at your chart and the price is thousands of pips away from the 200 EMA, the market is overextended. Even if the trend is up, buying at this point is dangerous. You are buying at the point of maximum tension. The professional trader waits. They wait for the price to retrace back to the moving average. They wait for the rubber band to go slack. Buying at the moving average is buying value. Buying far away from the moving average is buying hype. Let's synthesize this into a visual scenario. You open the daily chart of the Australian dollar to US dollar. Bias check. You see the price is below the 200 EMA. The background color of your mind should be red. You are a seller. Trend check. The 50 EMA is also below the 200 EMA. The death cross happened weeks ago. The trend is confirmed. The setup, the price rallies. It moves up for 3 days. Beginners are buying, thinking it's a reversal. The trap. The price slams into the 50 EMA. It touches the line and stops. The trigger. You see a bearish engulfing candle close exactly on the 50 EMA. The RSI is showing hidden bearish divergence, continuation signal. This is the holy grail of technical setups. You have the long-term trend, the medium-term dynamic resistance, and the momentum all shouting down. You sell. The price collapses as the dog snaps back to the trend. But even with the map, support/resistance, the vehicle candles, the dashboard RSI, and the GPS moving averages, you are still missing one critical variable. The variable that dictates volume. The Forex market is open 24 hours a day, 5 days a week. But it is not active 24 hours a day. There are specific windows of time when the whales surface and the water gets turbulent. If you try to trade the best setup in the world at the wrong time of day, you will sit there for hours watching the paint dry, only to get stopped out by a random spread spike. You need to know the schedule. You need to know when London wakes up, when New York goes to lunch, and when Tokyo opens the vault. Time is not just the x-axis. It is the pulse of the market. In the next part, we are going to break down the Forex market sessions. We will reveal the kill zones, the specific hours of the day where 80% of the daily volume occurs, and why trading outside of these hours is a waste of your capital. We are going to synchronize your watch with the world's money. Let's check the time. The Forex market is often advertised as the city that never sleeps. Brokers love to tell you that you can trade 24 hours a day, 5 days a week. They sell you the dream of waking up at 3 a.m. on a Tuesday, clicking a button, and making money in your pajamas. While it is technically true that the market is open, treating every hour as equal is the fastest way to drain your account. Imagine you are a fisherman. You can technically cast your line into the ocean at any time of day or night. The ocean is always there. But experienced fishermen know that fish only feed during specific windows of the tide. If you cast your line at high noon when the sun is blazing and the fish are hiding in the deep, you will sit there for 6 hours, catch nothing, and get a sunburn. The fish haven't left the ocean. They just aren't active. In Forex, volume is the fish. Without volume, the price does not move. Without movement, you cannot make a profit. In fact, trading during low volume hours is actually dangerous. When volume is low, spreads widen. The gap between the bid and the ask price increases, meaning you start the trade deeply in the red. Furthermore, low liquidity means that a single erratic order can spike the price randomly, hitting your stop loss before the trend eventually resumes. You need to stop thinking of the Forex market as one continuous stream and start viewing it as a relay race between three massive financial centers: Tokyo, London, and New York. The baton is passed from one session to the next, and understanding the personality of each runner is critical to your strategy. Let's start with the Asian session, often referred to as the Tokyo session. This kicks off around 7 p.m. Eastern Standard Time, depending on daylight savings. The Asian session is the accumulation phase. Historically, this session is characterized by lower volatility and consolidation. The massive hedge funds in London and New York are asleep. The primary players are central banks in Japan, Australia, and New Zealand, along with commercial exporters managing their currency risks. If you are trading pairs like the euro to US dollar or pound sterling to US dollar during this time, you are likely watching paint dry. The price might move 15 pips in 8 hours. It bounces back and forth in a tight, narrow range. We call this the Asian box. Many beginners lose money here because they try to force a trend trade in a ranging market. They see a tiny breakout, they buy, and the price immediately falls back into the box. However, for the astute trader, the Asian session is not for trading. It is for marking territory. You draw a box around the high and low of the Asian session. This box sets the stage for the drama that is about to unfold in Europe. Next comes the London session, starting around 3 a.m. Eastern Standard Time. This is the heavyweight champion of the world. London is the financial capital of the Forex market. Approximately 43% of all global Forex transactions flow through London. When London wakes up, the volume graph on your screen should look like a skyscraper shooting out of the ground. This is the expansion phase. The market explodes out of the Asian box. But here is where the banks play their dirtiest tricks. We often see a phenomenon called the Frankfurt fake, or the Judas swing. Imagine the Asian box has a high of 1.1050 and a low of 1.1020. At 3 a.m., the price suddenly shoots up to 1.1060. Breakout traders jump in long. The trend is starting, they scream. Then at 3:30 a.m., the price violently reverses, crashes back down through the box, and plummets to 1.0900. What happened? The institutional algorithms pushed the price up to trigger the stop losses of short sellers and to trap breakout buyers. They created liquidity to sell into. Once they grabbed the orders, they drove the true move of the day. If you are unaware of this London Open dynamic, you will be the victim of this trap every single morning. Finally, the baton is passed to the New York session, beginning at 8 a.m. Eastern Standard Time. This is the powerhouse. The US dollar is involved in nearly 90% of all currency trades. When New York comes online, the volatility can be explosive, especially around 8:30 a.m. Eastern Standard Time when major economic data like GDP, inflation CPI, and unemployment NFP figures are released. But the most profitable time of day, the holy grail of time slots, is the London-New York overlap. This occurs between 8 a.m. Eastern Standard Time and 12 p.m. Eastern Standard Time. During this 4-hour window, the two largest financial centers in the world are open simultaneously. The London traders are coming back from lunch and finishing their day, while the New York traders are sipping their coffee and firing off opening orders. Liquidity is at its absolute peak. Spreads are at their tightest. Trends are at their strongest. If you can only trade for 2 hours a day, this is where you must be. This is the kill zone. Let's run a day in the life simulation of the pound sterling to US dollar pair to see how this narrative plays out. 7 p.m. to 2 a.m., Asia, the price drifts sideways between 1.3000 and 1.3020. It's boring. The novice trader tries to scalp a few pips and loses money on the spread. The pro trader is sleeping or just watching. They draw a rectangle around this 20 pip range. 3 a.m., London Open, a massive green candle spikes up to 1.3030. The Judas swing. Novices buy the breakout. The price stalls. 3:45 a.m. The price aggressively reverses, slamming down to 1.3000, then breaking the Asian low to 1.2980. The true trend is revealed. It is a bearish day. The initial move up was a fake out. 8:30 a.m. New York Open, the price has been trending down slowly. It is now at 1.2950. US news comes out. Inflation is higher than expected. This is good for the dollar, bad for the pound. 9 a.m. The overlap. New York traders see the London trend down, and the fundamental news, bearish. They pile in. London traders add to their short positions to maximize profits before they go home. The volume surges. The price melts away, dropping from 1.2950 to 1.2850 in a single hour. 12 p.m. London close. The European traders go home. Liquidity drops significantly. The trend often pauses or retraces slightly as traders take profit. 5 p.m. The dead zone. The New York session winds down. The spread on pound sterling to US dollar widens from 1 pip to 5 pips. The market becomes a ghost town until Tokyo opens again. If you tried to enter a sell trade at 4 p.m. Eastern Standard Time, you missed the move. The train has already left the station. You are trying to sell at the bottom of the move, right when professional profit-taking is about to cause a bounce. This is why time is just as important as price. You must build a schedule. If you live in California, the London Open is in the middle of the night. You might have to become a New York session specialist. If you live in Australia, the Asian session is your daytime, so you might need to trade pairs like Australian dollar to Japanese yen or AUD/NZD, which actually move during those hours, rather than the euro to US dollar. Aligning your biology with the market's geology is a prerequisite for survival. You cannot fight the sun. We have covered the technicals. You know how to read the candles, the structure, the momentum, and the time. You have a Ferrari of a trading system, but a Ferrari without brakes is just a death trap. You can have a 90% win rate strategy and still go bankrupt if you do not understand the mathematics of ruin. You can predict the market perfectly for 3 weeks, and then lose it all in one bad afternoon because you let your ego take the wheel. The final boss of trading is not the market. The final boss is looking at you in the mirror. In the final installment of this deep dive, we are going to discuss risk management and trading psychology. We are going to give you the mathematical formula that ensures you can survive a 10-trade losing streak without blowing your account. We are going to teach you how to position size like a hedge fund manager, not a gambler. This is the boring part that saves your life. Get ready for the most important lesson of all. Welcome to the final level. We have spent 9 videos building a sophisticated engine. We have covered market structure, candlestick patterns, indicators, time frames, and market sessions. You now possess the knowledge to analyze price action like an institutional analyst. But here is the cold, hard truth that no one wants to hear. You can master every single concept we have taught you. You can have a win rate of 70%, you can be the smartest person in the room, and you can still wind up broke within 6 months. Why? Because while technical analysis tells you when to enter, risk management dictates if you survive. Most beginners treat trading like a trip to Las Vegas. They deposit $1,000, and on their very first trade, they risk $200 because they feel lucky. They want to double their account in a week. This is not trading. This is financial suicide. Let's look at the mathematics of ruin. This is non-negotiable math. If you lose 10% of your account, you need an 11% gain to get back to break-even. That is manageable. If you lose 50% of your account, do you need a 50% gain to recover? No. You need a 100% gain just to get back to where you started. You have to double your money just to be average. If you lose 90% of your account, you need a 900% gain. That is a statistical impossibility for a novice. This is why the golden rule of professional trading exists. Never, under any circumstances, risk more than 1 to 2% of your account equity on a single trade. Let's play out a scenario. Imagine you have a $10,000 account. You follow the 1% rule. This means your maximum loss per trade is $100. You go through a terrible losing streak. You lose 5 trades in a row. It happens to the best of us. After 5 losses, your account is down to $9,500. Roughly, ignoring compounding for a moment. You are still in the game. You are still alive. Your psychology is intact because the loss is a business expense, not a life-changing disaster. Now imagine the cowboy trader. He risks 10% per trade because he wants to get rich quick. He hits the same 5-trade losing streak. Trade 1, lose $1,000. Balance $9,000. Trade 2, lose $900. Balance $8,100. By the end of the streak, he has lost over 40% of his capital. He is devastated. He is now desperate. To make that money back, he starts revenge trading. He increases his position size, abandons his strategy, and shortly after, the account hits zero. The 1% rule is your bulletproof vest. But how do you actually calculate it? This is where position sizing comes in. Many beginners think risk is determined by where they place their stop loss. They think, if I have a wide stop loss, I am risking more. This is false. Risk is a fixed dollar amount. If you are risking $100 on a trade, it does not matter if your stop loss is 10 pips away or 100 pips away. You adjust your lot size, the volume of the trade, to ensure that if the price hits your stop loss, you lose exactly $100. If your stop loss is tight, 10 pips, you can trade a larger lot size, e.g. 1.0 standard lot. If your stop loss is wide, 100 pips, you must trade a tiny lot size, e.g. 0.1 mini lot. You must use a position size calculator before every single trade. You input your account balance, your risk percentage, and your stop loss distance. The calculator tells you exactly how big your position should be. If you are guessing your lot size, you are gambling. Period. Now let's talk about the holy grail of profitability, the risk-to-reward ratio, RR. You do not need to predict the future to make money. You do not need to win every trade. In fact, you can be wrong more often than you are right and still become a millionaire. How? By ensuring your winners are mathematically larger than your losers. This is the concept of R multiples. If you risk $100 1R to make $100 1R, that is a 1-to-1 risk-to-reward ratio. You need to be right 51% of the time to profit. But professional traders hunt for 1:2 or 1:3 setups. If you risk $100 to make $300, that is a 1-to-3 ratio. Let's run the numbers on a sample of 10 trades with a 1-to-3 ratio. Imagine you are a terrible trader. You lose 7 out of 10 trades. You have a 30% win rate. 7 losses x $100 risk equals minus $700. 3 wins x $300 profit equals plus $900. Net result, plus $200. You lost 70% of the time, yet you made money. This removes the pressure to be perfect. You stop trying to outsmart the market and simply let the probabilities play out. You become a casino owner. The casino doesn't care if a player wins a single hand of blackjack. They know that over 1,000 hands, the math guarantees the house wins. You are the house. But all the math in the world cannot save you from the final enemy, your own brain. Trading psychology is the hardest skill to master because human biology is wired to fail at trading. We are evolved to run from danger, fear, and hoard resources, greed. When you are in a losing trade, your brain screams, hold on. It will come back. Don't take the loss. This is loss aversion. You move your stop loss further away, praying for a miracle. The loss grows from manageable to catastrophic. When you are in a winning trade, your brain screams, take the profit now. It might reverse. Grab the money. You close the trade early, taking a $50 profit on a trade that was destined to make $500. You cut your winners short and let your losers run. This is the exact opposite of what you must do. The solution is not willpower. The solution is systemization. You must have a trading plan. This is a physical document printed out and sitting on your desk. It states exactly what pairs you trade, what times you trade, the exact criteria for entry, e.g., price at support plus hammer candle plus RSI divergence, your risk percent per trade, your rule for moving stop losses to break even. If you take a trade that does not adhere to your plan, you have failed even if you made money. If you take a trade that follows your plan perfectly, and it loses money, you have succeeded. You executed your business process. The outcome of any single trade is random. The outcome of 100 trades is consistent. You need to become a robot. Good trading should be boring. If you are feeling an adrenaline rush, if your heart is pounding, if you are sweating while watching the charts, you are trading too big or you don't have a plan. Professional trading is as exciting as watching a bricklayer lay bricks. It is repetitive, precise, and disciplined. We have reached the end of our masterclass. Think back to part 1. You looked at a chart and saw chaos. You saw red and green flashes. Now look at that same chart. You see the market structure, the map. You see the candlesticks, the language. You see the support and resistance, the battlefields. You see the trend lines, the path. You see the RSI and moving averages, the dashboard. You see the market sessions, the schedule. And you see the risk parameters, the safety net. You are no longer blind. You have the tools. But tools do not build a house, the builder does. The journey from knowing to doing is long. You will face losses. You will face doubt. You will want to quit. But remember the statistic we started with. The 90-90-90 rule. 90% lose 90% in 90 days. You are now armed with the knowledge to be in the 10% who survive. Do not rush. Open a demo account today. Practice these concepts with Play Money until you can triple that demo account. Prove to yourself that you are disciplined before you risk a single dollar of your hard-earned savings. The market will always be there. The opportunity will always be there. The question is, will you be ready? This concludes our 10-part series on how to read a Forex chart. We have turned on the lights. Now it is time for you to walk the path. If you found value in this education, if you are ready to treat this profession with the respect it demands, then you know what to do. Start analyzing.